Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. All the comments and subscribers, I greatly appreciate it. This week up is Lululemon, part of our series with Lululemon and Under Armour, the Battle Royale, to figure out which athleisure workout company is the best investment. This week, we're going to look at Lululemon. We're going to go through historical cash flows. We're going to project in the future. We're going to figure out how much hard cash money this company makes. And if we bought it today and held it for a decade, how much could we make by owning the investment? Ready? Let's get to work. As always, I want to encourage you to read the 10K. Now, behind me is their annual report, or the 10K for Lululemon. Please read it for every company you're considering, and every company you own in your portfolio, you should read it every single year. We're going to evaluate the stock, like we do with all of our stocks, on the 5 key attributes. We're going to, number 1, top-line revenue growth. It must be growing revenue. Number 2, earnings growth. I want to see EBITDA growing. Number 3, strong free cash flow, obviously. Number 4, low debt. Number 5, well-priced. What is a well-priced stock? A well-priced stock is a stock with a conservative forecast that can beat the market. That's what we're looking for. And we're going to judge Lululemon on those factors. Ready? Let's dive right into the material and get to work. Lululemon's annuals are stated as of January 31st. That's their fiscal year. So it's Jan 31 and back 12 months is their fiscal year. Behind me is revenue for 9 years of Lululemon, and you can see it's an absolute growth machine, which is fantastic. That's kind of what we expect for such a company that historically is traded at such a high premium to market. 1.3, maybe 1.4, give them a little credit. $1.4 billion of annual revenue. These are on millions, by the way. $1.4 billion of annual revenue in 2013, and that number has grown to 1.6, 1.8, 2, 2.3, so on and so forth, all the way to 4.4 last year. That's a 16% annual CAGR, or consolidated annual growth rate, which is very, very strong. Love to see double-digit revenue growth, and it checks our box for growing revenue. The next we look at is EBITDA. Now, EBITDA is the enterprise level earnings. We don't look at earnings per share here because as a CFO, I can somewhat control EPS by buying back shares. If you look at EPS is earnings divided by shares outstanding, do you get earnings per share? Well, if earnings are going to be flat, I can grow earnings per share by reducing the denominator in that equation. So that's why we like to put that off to the side, and we want to look at the business as itself. Does the business itself grow? Then we look at per share value to get even better detail. But right now, I want to know that the earnings at the enterprise level can grow. EBITDA is a proxy for stabilized enterprise earnings. And yes, it is growing a wee bit weak here, but it is growing over time and getting larger. Margins are also getting bigger, which is nice to see over time. 12% annual growth rate here, slightly less actually than 16%, but at least it's growing. Margin might not be expanding, but at least it's growing. Meets the criteria for us. They're able to grow their revenue and earnings together. The next thing we need to calculate is enterprise value. Enterprise value is the entire value of the business, both the equity and the debt. Think of your house. If you were to go buy a house, the value of the house is what you bought it for, the enterprise value, the market. You then go to a bank to borrow some of it and pay some of it in cash. That's your equity piece. But the value of the house is what it is. So we want to combine debt and equity when we value Lululemon. Debt's pretty simple. It's zero. That's handy. Excess cash is cash that is building up on the balance sheet that they haven't paid out in a dividend. They haven't used to buy back shares with it. They haven't get a special dividend or made it for an acquisition. It's literally just excess cash. And you want to exclude that from the valuation of the business. If you were to acquire Lululemon, let's say they merged with Under Armour, Lululemon would distribute this cash out to the existing shareholders prior to selling the business to Under Armour, hypothetically. That's why we want to remove it from the enterprise value. Market cap is simply shares outstanding times average price. And that has grown nicely, five-fold from $8 billion to $41 billion over this time frame. I add these up and I get basically the market cap is the enterprise value in this company because debt is zero. If you do this for some other big industrial companies like Caterpillar and so forth, where they have a whole lot more debt here, this number will change dramatically. Enterprise value is currently at $40 billion. It's been as low as in the single billions, which is much, much cheaper than it is now. Debt metric, right? This is our risk of bankruptcy measure, which is nice to see that it's zero. We love seeing that. And then enterprise value to EBITDA. This is the market multiple that we are paying for the business itself, the enterprise. And all this is saying is it's taking the actual enterprise value, the total value of the business, and dividing that by the number of years it would take the business to earn its own cash flow and value. Cash flow is in parentheses there because it's EBITDA, not free cash flow. It's a common ratio used in investment banking and private equity as a quick gauge from one business to the next. But what I like to show here is the premium that is being charged for this business. Earlier in the decade, you can buy this business at sub 20 times. That means 20 years of forward earnings are expected before you can break even this business, or lots of growth, one of the two. And that has gone up with the rest of the stock market to an absolute blistering level of 40 times enterprise value. That means if Lululemon does not grow, it would take 40 years for the business to earn its own cash value back, which is obnoxiously high. So it must grow. And the thing is, if it doesn't, if it were to post earnings that underreport growth, then the stock is going to take a massive hit, much like you're seeing in the stock market with all the growth names. When growth misses, the stock is hammered for it. That's why you want to be careful here. But this also tells me that the value of the company, the stock price, has actually gone up tremendously, not necessarily because of earnings, but more because the market multiple has expanded, and that means it could actually contract as well. You could have bought this company three years ago for 16 times earnings. For the same dollar of earnings today, you're now paying 40 times. But most of its history, it has been in the, call it 20x. So let's take that in mind as we go forward. Let's take a look at free cash flow. Okay, before we dive into free cash flow, I want to remind you to check out my websites down below in the link, Cash Flow Investing Pro. I both teach a course where I give you this Excel sheet and I walk you through how to build forecasts so you can build your own portfolio. I also have a cash flow club where I produce one-pagers multiple times a month, far more than videos that I could produce. So you can check that out, cashflowinvestingpro.com. Okay, let's hit the cash flow statement, my favorite statement, your favorite statement, the cash flow statement, right? That's where the rubber meets the road. That's what this channel is fundamentally about, the hard cash money. So what is this CFO? Cash flow from operations. That's the first third of the cash flow statement. If you read the cash flow statement, it's always cash flow from operations, cash flow from investing, cash flow from financing. Basically, the cash generated from operating, what they invested the money in, and then how they financed the business at the very bottom. Okay, they made $280 million of hard jack last 2013, and that has grown, call it three times in value. Now last year they made $800 million of hard jack from running their business, which is selling athleisure, all their various products. That's a 14% annualized growth rate. Come down to EBITDA, 12% annualized growth rate. Good job accounting. Love to see that. Where cash flow is reported accurately is this is a rough test, but it's a good gauge that what's being expensed on the P&L is lining up with the actual cash money that's coming in and out of the business. I love to see that. Good job, team. Okay, CAPEX. CAPEX, what is CAPEX? CAPEX is what they have to invest back in the business. It's a requirement every year. You got to change light bulbs, you got to buy new computers, you got to paint the building, you got to do all this stuff to keep the engine running. It's not acquisitions. It's not buying mirror. It's not expanding into footwear like they're doing unless they build a factory, then it's CAPEX. But basically, this is the cash money that every year they have to peel out of this $800 million, put back in the business to keep the ball rolling. And what we want to find is a company that when I net these two, I have strong cash flow. And that's exactly what I'm saying here. So back in the day, 2013, they made $280 million of cash selling t-shirts. They had to peel off basically $100 million to put back in the business. And that $100 million in equipment helped them generate the future cash flow. So they are tied together. You can't just cut this off. But basically that means that was $100 million that passed through to the equity owners. Now, fast forward in time, that has continued to happen. Now, last year, $800 million of cash. They peeled off $230 million, and what they're left with is $574 million of pure cash that has no home. It just sits in the balance sheet. And lo and behold, what do you find? Zero debt. And look at that, a nice healthy cash balance in excess of what's in the checking account. This is just extra cash. That's what I like to see. That's why you watch this channel. That's what we're hunting for. It grounds us in rational investing is how much cash money, how much jack do they make? The reason I like cash, one tangent, bear with me, is that you can audit it. When I don't know who their auditors, it might be PwC, KPMG, one of the big boys. When they audit, they go to Lululemon and they say, hey, let me see your bank statements. They go to the bank and they say, how much do you have in cash at the end of the fiscal year? The bank says, oh, you're their auditors? I will give you the information. And you got a third party that's verifying the cash balance in the account. Now, cash balance isn't everything. There's lots of things you can do at the end of the year to try to boost cash balance. I get that. But the fact that you can have a third party say, yes, this money at least came in and went out of the account. Here's the existing balance. That's tangible. Something like revenue, especially if it's monthly recurring revenue, you can kind of massage how you receive that revenue. If it's like Snowflake, for example, where you're buying credits that you expect to use in the future and you can only recognize the revenue as it's consumed, that's much more ambiguous than cash money that lands in the bank account. That's why we focus here. So it's a long tangent, but thanks for bearing with me. So now, free cash flow to equity. This is what you and I are buying as the equity holders, the common stock owners of the business. We have a claim to this number. That's what a share means. We are one of 125 million shares outstanding. And what I don't like how this has grown. There's no reason for this to grow. If they are generating this much cash, why are they issuing more shares and diluting the existing shareholders? They should be buying back shares. Lululemon, please do that. There's no reason for you to be issuing shares. I get that some of this is employee comp. That's fine, but you should be buying it back every year in cash. This is our ownership. If I put it on a per share basis, that's this number. So this is enterprise level free cash flow. This is the number of fully diluted shares outstanding. Divide the two, and I get a per share number. Now, this is why we don't look at EPS. I want to make sure that the business itself is large and it's growing. And only after I check that box do I look at, okay, what's free cash flow? What's the per share value? Because by changing this number, I can affect these. But this is growing. Check that box. Excellent. This is okay. Not growing too much, only 1%, but that should be negative. They should be buying back shares. But basically, if you bought this business back in the day, you got $1.67 in value. You're now getting $4.60. That's a 4x move. Great job in a decade. That's 4 times the cash flow that you would have had in a decade. Great move. Now the question is, this is the value part of a business. The value is right here. The question is, how much do you pay for that, right? Price is what you pay, value is what you get. This is the price per share that you have to pay for it. And I put in a convenient yield here just for relative comparison, much like the enterprise value to EBITDA is a relative value. The free cash flow yield is a relative value. This value relative to this price gives me a yield. And what you noticed is it was nice, kind of 2.5%, almost 3% cash flow yield back in the day. But as the market multiple has shot up to 40 times and this price went from less than $100 to over $300, this yield collapsed in half. So now you're yielding very, very little, which is going to be hard for this business to really pencil out. You're going to have to assume a pretty steep growth curve to pencil that out. And therefore your investment is based on a future growth which no one can control nor predict well. So that's the difference. That's how yields affect price. This is the value. This is the price you pay for that value. Okay, let's go forward and forecast Lululemon, figure out how much cash money it's going to make in the future, and if we bought it today, what it's worth. All right, shameless plug. Remember, check out cashflowinvestingpro.com. In the upper left corner on the website, you will see the Cash Flow Club. Click that. You can join, and again, you'll be getting one-pagers multiple times a month where you're getting a forecast, 10 years of history, and a lot more stocks than I can review on the web channel. Okay, here we go. So what we're doing here is we're going to grow Lululemon at 40% year over year. What basically happened is prior years were suppressed due to COVID, and they've now fully opened all their retail stores. They're kind of getting back. So they're going to see a large jump in the year-over-year numbers for Lululemon. They're on track, even to beat that number. I think they're on track for 1.5 billion. I'm leaving it at 1.4, just a little hedge. And I basically bring down the growth instantly after they level set back to where they used to be and grow at a steady 12%, something they've been doing historically over time. Now, that's probably a little aggressive. Probably could bring this down over time a little bit, maybe drop this by 2% every month, bring that back down to something that's a little bit more reasonable, maybe 8%. But the idea here is that the forecast is anyone's guess. No one saw COVID coming. No one knows what's going to happen in the future. Are we going into a recession? Are we not going into a recession? The Fed going to print money? Are we going to have inflation? Are we not going to have inflation? All those are giant guesses. The real value here is what company do you own, and what do you own as cash flow. The forecast is basically just a guess, and as long as you're not too overly aggressive with the forecast, or you're willing to buy into this forecast and own it, then you can buy the stock. All right, but I'm going to leave it at the 12% because it's what I had, and I want to keep. I think they're going to continue to grow. I think adding that. Adding the shoes in their business. There's lots of room for this brand to continue to grow. So I think 12% is a reasonable benchmark for them out 10 years. That basically takes $1.4 billion of EBITDA and makes it $3.8 billion over this decade time. I apply a 20 times market multiple to it, and I get $77 billion in value. Now remember, they're 40 times value right now, so I'm bringing that down in half, the market multiple. I'm growing earnings, but I'm cutting the market multiple in half because it's just way too expensive. 20 times, $88 billion of value, no debt, plus some cash, gives me basically $78 billion in market cap. Divide by shares gets you $625.82 out 10 years for Lululemon on an EBITDA market multiple basis, which is a relative value. Ready? Let's do cash flow. Free cash flow is the exact same thing. I'm going to start with my free cash flow. They have no debt, so this is CFO minus CAPEX, divide by shares outstanding. I get $6.38. That's up 40%. I'm going to grow at the same growth rate. I'll get roughly $17.70. Again, a big estimate, long-term out, way out there. $17.70. I'm going to apply 2.3% market yield to that, which is higher than the 1 and change they have now, back closer to the long-term average. And I get $769.58 as a long-term, out 10 years, price target for Lululemon. Okay, now the fun part. Now we actually get to look in the stock market and figure out see what the stock price is trading at. Remember, don't look at the stock market. The stock price is probably fairly valued twice a decade. Once it's blasting through fair value, the next time is it's crashing through fair value. So really, the stock market is just a wild guess, much like everything else. You want to form your opinion of what you're willing to pay for yourself, then go look at the market. So we have an opinion out 10 years. We think it's worth $700, roughly $690, $770. And so lo and behold, I look in the market. I can buy as much stock as I want at $300 a share right now. So we pop this into a handy-dandy IRR chart just using the Excel formulas, and I get the pro rata cash flow that I own. This isn't dividends. This is just a percentage of the free cash flow that I own based on not buying one share. I bought the share for $300. I sell it for $697. I get this stream of cash flow, and that's a 13% IRR. If I were to put that into a distribution curve, let's say that you're watching the video today, but you go back in 6 months, you want to see it again, which I appreciate the view, by the way, do that. So if the stock market price moves up and down, as it goes above 300, I'm much less interested. Frankly, as it comes down, I am much more interested in the stock. I do like this stock. I think the mirror investment was a poor decision. I think going into the shoes is a very good decision for them. But I'd like to see that stock more in the $250 range for me. That would be a big buy. I don't like that I have to have a double-digit growth rate for a decade. That's very risky. We saw that with PayPal, we saw that with Facebook, we saw that with Salesforce, all those companies where you're basically running out double-digit growth rates for a decade. If they miss that growth curve for whatever reason, the stock price is hammered. I love stocks that I can buy with a single-digit forecast and making large double-digit returns. That's the best for me risk-return trade-off. And if I have to say I need double-digit growth for a year, and given that I make 13%, that's not enough for me. I want to see 20% IRR. Consider this: if you have 20 stocks in your portfolio and you're focusing your portfolio, you have to be very, very selective. So you're looking for reasons to exclude businesses all the time. And this risk-return trade-off for me just isn't attractive. So I'm going to give it a giant meh. Why? Because I like the company. Let's review let's review the 5 key factors. Number 1, top line revenue growth. Yes, it's growing. Great job. Number 2, EBITDA. EBITDA is growing phenomenally well. Strong free cash flow. Yes, check that box as well. Low debt. Debt is 0. Check the box. Finally, well priced. No, for me, it's not well priced. I want to see the stock come back down. I would love to see Lululemon management buy back some shares. That would be a great use of cash for that free cash flow, or pay out more dividend, right? Kick a dividend out. You've got the free cash. Go ahead and do it. But either way, this return for me just isn't quite there. I want to see a nice, 15, 20, ideally greater than 20% IRR. And to do that, you have to be very selective. So we're a pass. Now, I will take a minute while I have your attention and just remind you, check out my website, cashflowinvestingpro.com. I teach a course there. I give you this Excel financial model. I give you 3 hours of prime content with slides so you can walk through how to read a 10K. How to pull revenue out, what to look for, how to read an income statement, how to read a balance sheet, how to read a cash flow statement, how to calculate debt, how to calculate free cash flow, how to calculate fully diluted shares. If the stock split, how do I adjust the stock price for the split? How to build a forecast, what to look for in a forecast, how to pick out 20 or so stocks to build yourself a diversified, strong, cash flowing portfolio that hopefully will do what you want it to do over the next decade. That's the idea with the course. Definitely check it out. Also join the Cash Flow Club. If you don't want to do the work yourself, but just want ideas to consider, join the Cash Flow Club. We kick out all kinds of ideas every month. We're doing 10, 12 stocks a month. And in there, some are jewels, some are dogs, but the idea is to look at and get a perspective of what's out there. If you're going to be investing for your lifetime, A, the course itself will teach you what you need fundamentally to know that you can carry throughout your life. B, the Stock Cash Flow Club is going to give you perspective over time as you see one pager after one page. You get a feel for the optionality that's out there. The spectrum of investment is really what you really want. So definitely check out the club. You can download a free one-pager, by the way. If you go to my investment, you go preview Cash Flow Club, scroll down, I give away a free one-pager. You can check it out. It's got 10 years of historical financials in it. It's got a forecast up there. I got notes in there. There's a stock price, and I summarize the 5 key factors right on the right-hand side. Check that out. Thank you very much for watching the reviews. I really appreciate it. Hit the like button and the subscribe if you like the channel. Throw me a comment down below. Let me know what you think of this investment. Am I wrong on the growth rate? Is the growth rate going to be double digits, like 20%? What do you like, this one or the next video is going to be Under Armour? Which one do you like better? Let me know in the comments below. Up is going to pop right now some stock reviews. If you want to see other value-based investments, how I handle oil companies or how I handle software companies, check them out. Very, very cool. Hit the like button. Give me the thumbs up. Share it on social media. I really appreciate it. And don't forget to subscribe. Thank you very much. See you next week. Bye-bye.